Okay, everybody, welcome. It's a Friday. It's our last session of the trading week. This is Israel here. It's been a very interesting week in the markets. Um, I hope it's been good to you. And if you've been disciplined, if you've followed rules, if you've done what you should do, then I'm sure you would have had absolutely no problems at all. Right, so let's get into it. Let us get into it. Okay. So let's get rid of that. And voila, there we are. I'm not going to spend too much time today. I'm going to spend too much time today going over what price has been doing in the markets this week because we did a whole lot of that yesterday. In fact, we were supposed to have a teaching session yesterday. It kind of got hijacked into an analysis session. And so we are repaying the favor today. We're going to hijack what should be an analysis session and make it a teaching session. So as usual, when you guys get in, just sign in in the comment section. Let me know who is here. And we will get this show going. All right. Cool. GU's doing something very interesting. So that, let me see, this would have been the open of the day. Price has made a low beneath it. The question is, what's the dollar index doing? Let's look at that real quick. So, right. Okay, you see this a lot of the time when there's going to be an engulfing. There's obvious. Well, you see this almost pretty much all the time. When there is an engulfing, which is here, it is normal for price to go back. There you have it. To go back in that zone. Now the question is that what we've seen? In essence, if we have confidence that this is going to rip through up here today, or we've drawn that already, then this is the start of the day's dip inwards, and then it goes up. If it goes up, you expect G to come down, in which case could we have seen that already? Let's get a clean chart. All right, that's EU. This is GU. Cool. So, question is, have we seen the retracement to start the day? Was that the high of the day? In which case, yeah, so that looks like what's gone on to me. So, let me see now. Okay, this is a demo account, so I can, let me see. It's 26 pips. Give me a quick second. Right. Let's move this off screen here. Let's see. It's a Friday though. That's my worry. It is a Friday. And we all know how Fridays go. So, I don't know. If it's been any other day other than a Friday, I would be looking for this to at least come into this, back into this area here. And since it already made that low yesterday, the argument is that it's then looking for this. Either that there or this here. So, I'm in two minds, but it's a Friday. It's a Friday. This is why I don't like trading on Fridays, because all kinds of manipulations happen on a Friday. Let's see. What's EU doing? EU just went all the way back up. So something's holding GU down. EU's just going all the way back up. Yeah. So I don't know. Definitely not. Well, I know. I think I'm going to wait today out. I've made my profit on this move already this week. It'd be nice to make some more on a Friday, but I'm gonna sit to that. I'm gonna sit this one out. Yep. I'm gonna sit it out. And if it turns out I could have had some money, that's fine. Like we said several times, as a professional trader, your number one priority is to preserve your equity. It's not how much money you can make. Your first priority is to make sure you don't lose money unnecessarily. And then you can think about making it. So yeah. Okay. I'm going to paper trade this one. I'm going to paper trade it. And that will be it. So, cool. Let's get to it. Candlesticks. Candlesticks. One quick second. Just going to open up another chart here. And by the way, did you guys let me know, did you manage to catch any of those signals that we sent out at the start of the week? If you did, let me know. If you did, let me know. Right, so Candlesticks Part 2. Candlesticks Part 2. And away we go. Not you. Yeah. Cool. So we looked at last time the fact that a candlestick is a piece of information that tells us something about how a market maker views a price range. Every candlestick has 4 significant elements to it. There's an open, a close, which is downwards in a bearish candle, or upwards in a bullish candle, a high and a low. The distance from the high to the low, the bits that stick out at the top and the bottom of the candle called the wicks, and the rectangle in the middle is called the body. Now, I'm just going to throw out what we did yesterday. We did about 15 minutes on candles yesterday at the end of what was basically an analysis session. I'm going to assume that we didn't do any of that, right? So we're just going to assume or ignore the fact that we looked at anything of that nature yesterday and just go straight into doing it again today. Now, market makers are position traders. So it means in the markets for long periods of time, they analyze price over high time frames. When I say high time frames, I'm talking about the monthly, the weekly, and the daily primarily. If you are a scalper or a very, very, very short to maybe a session trader, we will add the 4 hour to that, but technically it's not a higher time frame. But this will work on the 4 hour. Anything, sometimes, anything beneath a 4 hour, just don't bother. You are dealing now with retail traders and you are not going to get a really good sense of what the market maker is doing except for how to manage your trade and what pockets of liquidity to get in and out at. So I'm going to use a daily chart for this. Every candle is a range. A monthly candle is a monthly range, and you see that the daily dividers are a monthly candle each. Weekly candle is a range. The 4 hour dividers are weekly candles each. And a daily candle is a range because the 1 hour dividers are daily candles each. One second, sorry. All right. Cool. So there is something about that range that was significant. What's my computer doing today? There's something about that range that was significant to a market maker in why it was made. For instance, the entire body of the candle, let's use this one for a second here, is a range. There is a story being told here. Why did price get rejected from going, good to see you, Gerard. Why did price get rejected from going lower at that level? Why did it get rejected from going higher at that level? This here is the period range. It is significant. If it is on anything from a monthly to a daily and sometimes a 4 hour candle, there is a region of price hidden in this candle. So this, that's a 4 hour candle. No, that's not. Let's use daily one. Let's use a daily one. Let's use this one here. So there is a region of price here. Someone with far more information than you and I, and someone with far deeper pockets than you and I, came to the conclusion that this was a range for a day. Now, if you drop down, this candle here is the 21st of April, right? 21st of April. So let's drop down to a 1 hour chart and find the 21st of April on a 1 hour chart. There you have it here. So this is the, yeah, that's it. So this candle here, right? That entire range that we just drew, I'm going to shorten it. Let me show you this. That's it here. On this particular day, where price opened up here, remember, on a down day, price opens, then forms a high, right? Then runs to the low, and then retraces and closes back just short of the low, 9 times out of 10. And then it retraced up here and closed here. Now I'm going to change this. Let me see now. So this is the body of the candle. The distance between the open and the close is the body of the candle. Good to see you, Natalia. This is the top wick here. So I'm going to put that in a different color. That's the top wick. To make that clear, I'm going to put that in, let's see now, I'm going to put it in blue. And I'm also going to put the bottom wick in blue as well. Please watch this carefully, what I'm about to show you. It may just save your trading life. Right. Now let's find another color. That blue looks, I don't know. To me anyway, that blue's offending my eyes. Let's see. Let's make it something less. Yeah, that's a bit kinder on the eyes. The blue's just very, very thick, very dark in my opinion. Right, so medium purple. There we go. I'm just going to draw a line out there. So that's the body. Let's make it, I don't know. Let's keep it, no, let's make it black. And let's make it, yeah. So this is the body. That's the high. I'm going to change the color of the high to a different color. So again, we can spot it. Let's make it purple for lack of a better way of, yeah, let's make it purple. And that's the low. Each of these three sections is telling a story. First of all, the entire range of that day. Someone felt on this particular day, and a day is a large enough sample size. It's not an hour or 4 hours, or a day is a large enough sample size. A week is even larger, a month is even larger. So the larger the sample size, the more specific or significant the information is. But someone is saying to you, we didn't think price was worth taking beneath that, above that high there. So there was a resistance here. There was a support there. We don't want price dropping beneath that, right? We explored this area and decided to come down. We explored this area and decided to come up. In essence, and I want you to write this down if you're taking notes, they're telling you, right? This is what they're saying to you. That this is an area of reversal. This here is an area of reversal. 1 second. Where did I? Okay. Let's just write another one. And this time, let's change the color early enough. Let's make this Misty Rose. Make that 16. Reversal. That could be bigger. Make it 20. Cool. This is also an area of reversal. And quote and unquote, now I'm not being technical here. Quote and unquote, this was an area of consolidation. That's how I want you to think of this. Let's see, where can I put this to make it? I'll put it there. So in that area there, they're saying, nope, we tried it, it didn't work. In that area there, they're saying, again, we tried it, it didn't work. However, we're happy to play between this area and this area here. Well, think about it. If this is a reversal and this is a reversal and this is a consolidation, in essence, that's a premium, that's a discount, that's quote unquote fair game. Let me repeat. It's the exact same thing as a Fibonacci, right? So this is a new platform, so I've got to go set my Fibonacci up again. Right, red, black, I've got 23.6. No, I want it to be 21.4. I want that to be 0.214. And I want to add a 0.786 and call that the 78.6. Right. Cool. So what they have done is tell you their own Fibonacci. In essence, on this particular day, that top there was their own version of the 78.6, and that bottom there was their own version of the 21.4. That's all they said to you. They're saying, yep, we know Fibonacci is standard, but on this particular day, we believe high premium to be the wick and low discount or deep discount to be the bottom wick. The middle here is fair price. It's a fair price region. Why is that important? Let's go back to that candle now. Let's go back and see that. Right now, I know I wrote it in white, so let me change the background just so you can see the writings. I'm gonna go color scheme I hate, but let's do it yellow and yep. You know, nah, I can't do that. I can't do it. I can't do it. All right, so anyway, let me just get rid of the words. Just get rid of the words. Well, I'll put them here so I can put them back on a lower time frame where I can see them. So moving forwards, I was thinking, where are the high and the low levels? 21st of May, where the high and the low levels, 21st of May. Okay, they're missing. Let's put them back in. That's the high. And that's the low. Right, so you move forwards in time. And this is what you will see. Look at what price does in each of those levels. Let's drop down to a lower time frame so you can see this a bit more clearly. How does price treat those three zones moving forward? Well, the next time it comes into the reversal zone, what does it do? It reverses. It sticks around for a long time in this zone here because it's told you that this is now the fair value range. And the next time it comes up here, while it nicks it just a little bit in this case, but it still comes back down in. It comes again and comes back down in. Similar to how you treat a Fibonacci, at the point at which it completely violates that high and stays above it, this particular day, the 28th of April, is the new Fibonacci. On this day, they have now told you that the price range has changed. in essence, what you did here, come back and do here. But in between those two candles, in between the 21st of April and the 29th of April, these are the market maker telling you what they see, no, on 28th of April, sorry, what they see as fair value, premium, and discount. You sell here, or you buy here because that's discount. You sell in that range there because that's premium until a new range has been established. When the new range is established, we do the same thing all over again. That's the high. That's the low. That's the open. So that one's high has become this one's open. And in this case here, there is a very narrow candle. So if we go to the 28th of April, we should see, there we have it. That's it there. You see now, this candle, remember I said to you, if the wicks are far bigger than the body, it's telling you that that wick is a lower order block in a lower, or it's an order block in a lower time frame. So that now is the new range there. So we come back there, and I said that to you yesterday. Okay, I said I was going to repeat everything I said yesterday, so I'm going to do that in a second. But let's come back here. So this particular day, now that range in between there is far too narrow to be treated as any form of reliable order profile. So we know that if this body is so tiny, we are now, price is telling us that this range here itself is an order block on a lower time frame. And because we came from a 1 minute chart, a daily chart, sorry. Where is that now? We came from a daily chart there. If we drop down a 4-hour chart, we will see it. And there it is. That's the order block there. If you refine the order block, that's it there, right? Well, you will notice that that region there now has the same thing. That's now fair value. Everything beneath it is discount, so it's buying. Everything above it is premium, so it's selling. And you see that it then, and that holds all the way up to here. When it's violated fully there, then we reprice. All right. But do you get, let's go back to that 20. Do you get that principle? For those of you coming in late, you're going to have to watch the video from the start. I am not going to be able to repeat myself. But I have just shown how a candle works. So I'm going to delete that for the sake of this argument. Coming back here. This is how a candle works. It's the same principle as a Fibonacci. Assuming the body of the candle is the most significant part of the candle, price is telling you that is the fair value there. The same way with the Fibonacci, you would treat the 38.2 and lower as discount, 61.8 and higher as premium. Well, the market maker is telling you that this day, or if it was a weekly candle this week, this is a daily candle from the 21st of April. We divided it here on the daily chart. And then we just drop down. So that's the candle there. We just drop down to 1 hour chart to look at it because a daily candle is a 1 hour divider. That's the wick. 1 second. Actually, no, we got that wrong. 1 second. This is the bottom wick here, actually. That's the bottom wick there. So that should be there. Right? Cool. That should be there. So when we drop down to a 1 hour chart, the market maker has divided price for us. He's told us without needing to use a Fibonacci how he's viewing. So that should be here. That's where it closed. And this should be there. Cool. This body of the candle is a consolidation. We wrote that in already. Let's see if I can find the writings. Right. So that's the consolidation. That's the reversal. And that's the reversal. Right. Guys, I know this is tedious, but you need to see this. There's no other way to show it to you. So that's a reversal. That's a reversal. And this here was a consolidation. Price was happy to stay in this range here. Over there, it considered itself too expensive. Over here, it considered itself too cheap. Like I said, it's the same concept as a Fibonacci. Right? In a Fibonacci, the way we've taught you to use it, this here is considered premium. Anything above the 61.4. This here is considered discount. Now, we, for the sake of this, are going to make that, so that's deep discount. That is high premium. In essence, everything inside is considered fairly average price. It's the exact same concept as a period candle, anything from a daily and above. And it also works slightly less accurately on a 4 hour chart. That's the same thing. Price started here, went up. Market maker said, nope, come back in here. It came down, they went down. They said, nope, come back in there. In essence, in that region, it's telling you fair dues. That's here. This is how you really calculate what is overbought and oversold. Not with your fancy indicators, not with your stochastic, not with your RSI. This is the real concept, what's going on here, of overbought and oversold. Moving into the future, until price closes being above or beneath this candle. For the rest of this chart moving forwards, anything beneath there, you see it comes here, it says, nope, that's too cheap, it moves. It sticks around here for a while, it comes here. Even though it just about nicks it, it doesn't close there. It still retraces in because it's saying it's too expensive. And then on this day is when it violates it. On this day here, actually, yeah. On this day here, it begins to reprice itself. There is now a new range, and you can draw it out. However, the fact that it reprices here, remember, market makers are what? Position traders. Even into the future, when it comes back into that range and stays there for a while, they're telling you that the range we used here is now relevant again here because price has spent a significant amount of time in it. Well, what do you know? This then becomes overbought again, premium. This then becomes oversold again, discount, you see. And then when it settles beneath that range, it reprices again into a new range. Now, we looked at this yesterday. When you see a candle in which, like this one here, in which the wick is far bigger than the body, you don't use the body as your range. Why? Because market maker is now telling you that the vast majority of the action happened above and beneath. In which case you flip it. You are now interested in seeing what's happening inside the wicks as opposed to inside the bodies per se. So that day gives you two zones to work with, not just one. If you drop down to a lower time frame, one second, that was what day was that? What day do we just draw? What day do we just draw? Actually, this is a 1 hour chart, so we should be doing this on a daily chart. So let's find a daily candle where that happens. Let's use this one here. So you see on this particular day, the wick is far bigger than the body. Well, that wick is hiding a body of a candle on the lower time frame. This is now the range we're interested in. If you drop down to a 4 hour chart, you should see it. There we go. So that's the order block. Look, from here to here is the order block, right? That will then serve the exact same process or purpose moving forwards. When price comes back into that area, it will treat that. Let's go back there. It will treat that in the same way it treated those zones there. And if you, come on, chart. If you refine it, that's the zone there. Okay, so beneath it is too cheap. You see a reversal. Above it is too expensive. You see price come back into it. And then let's go to the 1 hour chart so you can see clearly. There we go. So you see it's treating it the same way until it settles above it, and then you reprice. What does this mean? It means that when you are looking at higher time frame candles, meaning weekly, monthly, daily, and sometimes 4 hours, this is why the open, high, low, and close becomes extremely important. This is how I deciphered for myself, not by studying anybody else's stuff. When price is traded in a range, I want to see the levels of the opens, highs, lows, and closes of the significant candles in that region price is currently trading in, because they are telling me a story. look at that here. So using this candle here. This is the the 16th of June. Look at what price leaves it, fine, but look at what happens when price comes back into that range here. I want us to examine this section of price action on this day. So on this week here, right? Let's look, price enters it here and it's still in it till today. Let's look at what, okay, also I will add this one. This is a different day, but you can see that this candle's high is valid in that range. That body is very similar to that body, so I'm not going to draw it. This low is very, let's see, this close here. Yeah, I'll draw it. It's far apart enough. It's not identical. So once price comes back to this range, remember, I'm not drawing this one because, look, it's too close to that one. So it's not needed. Right. And I will draw this one as well. Okay, so I'm going to draw this body here because it was relevant in that range. So let's pull this down here. Cool. We have 3 candles. 1, 2, 3. They formed on the 12th of June, the 15th of June. So that was a Friday. This was a Monday. And the 16th of June. So Friday, Monday, Tuesday from a month ago. But each of them's bodies. Now, this candle, for instance, here, because the wick was much larger than the body, in essence, this was the real zone in question, right? Same as here. This was the real zone in question. And for this one, the body would have done just fine, because the body was the significant piece here, right? But look at what, so in essence, each of them is demarcating to you a fair price level, an overbought and an oversold region, just by where it opened, closed, and where it formed the high and the low. The same way, one second, let me just, for those of you, because some of you are just coming in late, that's what we did down here, right? We're saying that this candle's wicks are places of reversal. In essence, they're overbought and oversold. Like a Fibonacci, the candle has divided itself into its own Fibonacci. The wicks are the high premium and the low discount areas. The body is the consolidation, the fair value area. If it's a candle where the wick is much larger than the body, then it's doing this twice in each wick. Now, so in essence, this has told us overbought and oversold regions of 3 days back to back 1 month ago. When price comes back into that price range a month later, look at what happens. In essence, price told on itself a month in advance. Well, look at what happens. So the lowest line is here. So it enters this range on the 7th of July, right? It says that's too expensive. It comes back down into the middle. It comes there, says that's too cheap, right? It goes back up, reprices itself here, then goes back up here again and says that's too expensive, that's too cheap. That's too expensive, that's still too expensive. Okay, this is too cheap, that's too expensive. It's told on itself in advance. Come back here. Now let's deal with just one day at a time. The 16th of June. Let's do it just one day at a time. So this day, it gave us high, low, open, close. Well, let's go back and look at it. It comes into the region here. You notice, okay, let's take those as well off. So we don't need this. We don't need this. I'm going to take that as well off. So that's the body of this candle, right? It's the body of this candle. Sorry, so I should be treating that line. That one's fine. And that there will be here. Right. Let's go back down. Can you see how a candle from a month ago has divided price for us a month later? Everything here is being treated as too expensive. Every time price comes up there, it's selling. Every time price comes down here, it's being treated as too cheap. It's buying. Right? Now the question is, using what as a reference? There. Look at that. You could have just said to yourself this week, I'm going to stock sell entries here. And I'm going to stock buy entries down there. That's using a daily candle from 1 month ago. Here. Now, the wick of this candle here doesn't exist, so that's the high of the next candle there. In essence, from this zone, where's the nearest high? It's up there. Where's the nearest low? It's the low from that same day. You have your Fibonacci. This is your fair value area. That's your high premium. That's your low discount. That's why we draw them out. But it doesn't make sense to do it on a 5-minute chart or 15-minute chart, even an hour's chart, because there is not enough of a sample size to tell you that that is necessary or that is reliable is what I'm looking for. You want to do this on monthly candles, weekly candles, daily candles, and sometimes 4-hour candles if you are a scalper. Now, do I just go about drawing willy-nilly? No. Why? If you start from this day here, these two candles exist between that zone. Just ignore them. This one drops down here, so you draw that one out there, but price hasn't gotten there yet. And where they overlap with each other, there's no point drawing two lines that are the exact same. You get better at this as you go along, become more mature with your trading. But it's a spatial recognition issue. Can you see what somebody with deep pockets is telling you about how they see price? How they divide price? That's it right there. So more so than haramis and piercings and dojis and rail tracks and engulfings, you can tell when prices change direction. So, we're going to teach you that, but you can tell when it's changed direction. In my opinion, this is the biggest story of a Japanese candle. This is the more in-depth piece of information it's giving you as to how to use it. Let me show you this a couple more times so you can see. Let's go somewhere where prices work both sides of the range. Let me open a new chart. Open a cleaner one. Let's use EU. Properties. Black and white. Get rid of the moving average. Right, so daily candle. See if I can show you the same thing again. All right, let's use, see, this candle here is quite beefy candle, isn't it? So let's use it. That's the open. Actually, this is the open. It's a bullish candle. That's the close. So, of course, in essence, it is telling you that this is what a market maker considers to be a significant area in price action. If you drop down to an hour's chart, look at what happens. Can you see? Same thing we just looked at. Until price fully leaves this range. What I mean by fully leaves, like here, for instance, now it's established a new range above that. So it's like a Fibonacci being expanded through. Now you have to do this again here. So you'd be looking for a candle that formed in this area. But while it's here, notice. Also, where's the controlling high just above this level? That would be this one here. Right? A controlling low beneath it. You have to go further back to see that one. I know you could pick here, you could pick there, wherever. I'll just pick, let me see. I will pick, I don't know, I'll pick this one. Let's just pick that one. In essence, it's divided the chart. And if I'm not going all the way down here, let's just pick the next high above this one here. Just pick that one. But my point is, we've just divided this chart into buy and sell. Can you see that? Buy above here, sell beneath there. It's that simple. Buy above the green line. Sorry, sell above the green line. Sell above the green line, buy beneath the green line here. Overbought, oversold. This is fair value. Look at that. Let's look at that. So what would you have been hunting? Well, market structure breaks, right? So When it came here, it came down here, did we get a market structure break? We did. We got it here, right? That was a market structure break. That was a market structure break. The price come back? Yes, it did. So you would have bought here, put your stop loss there. The moment you get above there, you look to close. You're expecting a reversal. In essence, you would have been out in that region. Your stop loss will be beneath the next low, 28 pips. Your take profit will be in the next hourly engulfing, which should have been there. Yeah, 2-1. Okay. Here, what are you waiting for? Market structure break. Where? There. In essence, the exit of one trade would have technically been the entry of the other. Does price come back? Yes, it does. Right? 19 pips. 100 pips. That's a really good trade. The moment you get back beneath there, you're out. Why? That daily candle has divided price for the next few days, next month, into discount above it, above the body of it, and premium beneath it, right? Would you have taken this entry? No. Why? You're still in fair price. Unless, of course, you saw this as a retracement back here for another entry. That's your call. Down here again, do you get a market structure break? Yes, you do. Where do you get it? You get it here. Does price come back into it? Yes, it does. Does it give you an engulfing in that region? No. So you don't take it. There's no reaction there. But even if you did, well, okay, that's a 1% loss. Fine, we move on. We come back here again. Well, market structure break. Where? There. Does it come back into it? Yes. This would have been a valid loss. In my opinion, this is the only loss you would have taken here. Why? Because there's a manipulation going on. So you're up, I don't know, 3 plus 8%. You're up 11%. You're now down 1%. So that's 10%. Another market structure break here. Does price revisit? Yes, it does. And this one pays you handsomely. 27 pips. Look at that. But again, the moment you get here, you're queasy. There's an engulfing there, you're out. What are you looking for? Another market structure break. Where? Here. That's the next one there. Right? Does price return? Yes. Does it return a second time? Yes. Let's assume you took the first entry. 42 pips. 113. Would I have taken this trade? No, because I'm looking at 42 pips to 72 back there. I'm not taking that trade. It's not worth it to me, risk to reward. However, it gives you a second entry here with a more defined risk. 19.5, 20 pips. 73. Now I can take that one. We get here. Where does it have an engulfing there? So we're out here. That's 4.5 to 1. What are you stalking again? The next market structure break. Where does it happen? There. Does price give you a reversal? Yes, it does. It comes back in. You enter. 25 pips. You're looking for 110. Does it get there here? No. It falls back down here. It's still not broken that low. It tries again. Then you lose. So you're now up 10 plus 8, 18, and you're now down 2. So you're down 16. You're up 16% overall. You've lost 2%. You've gained 18. Okay, so All right, fine. Is there another market structure break? Yes, there is here, right? Does price come back through it? Yes, it does here. Now, this is a dangerous trade for me. I don't like this. I can't find any way to frame my stop loss except down here at the least. 30 pips to 77. It's not worth it for me. However, it comes back in here, right? And then leaves it there. So it's giving me a more defined entry. So that's 25 pips to where? 98. But roughly about here, that's about 3.5 to 1. That's how they work. That's why when we draw them on the original time frame, you see the reactions. Ladies and gentlemen, that is how I present to you that you should really be viewing your candlesticks, especially on the higher time frames. Especially on the higher time frames. Monthly, weekly, daily, and to some extent, in some circumstances, on the 4-hour chart. Now, I want you to go do this in your charts. I'm gonna leave this there today. Let's end the week early. I'm gonna leave this there today. I want you to do this on your charts, monthly, weekly, and daily, and 4-hour. Can you spot this same phenomenon I've just shown you? Can you spot it with your own eyes? If you can, take screenshots and send them to me in Telegram. Any questions before I close down today? And I can imagine there will be a few because I know this has been quite heavy stuff. I could feel it as I was teaching it. I probably will go over it again with you guys in a closed forum, the registered students. But any questions on what you've just seen? Any questions on what you've just seen? When price abruptly goes beyond the speculated range and comes back, we call that a manipulation. Yeah, yes, but not necessarily. You only know it's a manipulation when you see what it did there. So if it went below that range and comes back and carries on the previous way, then yes, it was a manipulation. So yes, you are right. When it goes beyond that speculated range and immediately comes back, well, it doesn't have to immediately come back. It just has to come back within that time frame and carry on. In essence, it's a manipulation if you ignored it. If you ignored that one move, it would have just been normal in the other direction. In essence, the only reason price had to go that wrong way, in hindsight, was simply just to pick up liquidity and then carry on in the original direction. Yes, we call that a manipulation. Any other questions, anybody else? All right. No other questions. I will leave it there for today. Please go watch it again. And like I said, I will address this with you guys in a closed forum session to those of you who are registered students, because I understand, especially most of you on the call today. So I was a little bit iffy because I realized that the vast majority of those of you who did turn up for this class are beginners, and so I could feel your. But when we break down the foundations of the candlesticks, and you come back to this video after that one or that part of the curriculum, it'll make a bit more sense. But to the advanced students, when you guys watch this, especially for those of you going to watch it on the replay, it should make perfect sense to you. Alrighty, guys. In the absence of any further questions, so let's see. Do we want to look at any charts for the week so far? I don't know. We did all that yesterday. Price isn't really doing much today. Let me see. What's it doing today? Like I said, if this wasn't a Friday, I'd be looking for that, but it's a Friday. I'm not too sure. Also, the dollar index. Again, if this wasn't a Friday on the dollar index, I would say it would do this. Therefore, if it's going to push further down, then you'd expect GU to push up. So that, for me, is not clear. EU has already done the pushing up. If the dollar index pushes further down anymore, then we are gonna say that it'd be looking to attack that level there, and then maybe reverse there. But it's a Friday, so again, I'm not trusting anything. And if you look at the Swissy, let's see, let's look at another chart for the Swissy. Let's look at this one here. Again, if the dollar index is coming down, you'd expect Swissy to come down. It has come down already. It's already taken out this level here. So I personally, I'm not interested in any other trades this week, especially because we're on a Friday. Dollar index is at an area of decision. I'm going to let it make up its mind today. Tell me what it really wants to do next week, and then we'll take it from there. All right, guys. It's been great hanging out with you. See you on Sunday, 9:15. We should hopefully have Tucker back with us for Monday next week. But I'll see you at Sunday myself at 9:15. Tucker will see you at Monday and probably Tuesday evening as well. I'll be with you Tuesday morning. And so yeah, I'll be with you Tuesday morning and Wednesday night. Joshua will be with you Thursday morning. I'll be with you Thursday night and Friday morning as well. All the best. Have a great weekend. I'll see you guys in the Telegram and on the phone calls. I'm sure you have a lot to talk to me about how your week went in the markets. Until then, take care. Have a great weekend. Bye-bye for me.